3 weeks ago, we were told there was impending doom. There was a major collapse coming and a recession was definitely on the cards. There was calls for emergency interest rate meetings where the Fed was going to cut rates at an emergency meeting. 3 weeks later, we're at historic levels once again. The stock markets are at historic highs, the real estate market at historic highs, Bitcoin 14% off a new all-time high, and many of the tech stocks are back close to new all-time highs yet again. So how did everyone miss this low, and what is coming up next? That's what we're getting into in today's video. So make sure you have hit the subscribe button if you're new here on the channel. It's your home of macro cycle analysis with me, Jason Pizzino. We're covering Bitcoin, cryptos, the stock markets, and the real estate cycle today. And don't forget to smash up that like button. Thanks again for all of your comments down below as well, as you're beginning to see how these cycles continue over and over and over again. So without further ado, let's kick it off with the data for the traditional markets, and then I'll get into some of these major charts that look like Bitcoin's going on this major runaway bull market yet again. Some of the patterns are very surprising of how simple they are and how they often repeat. Before we get too far ahead of ourselves, let's have a look at how the traditional markets have continued on with this bull market, starting with the S&P 500 financials after a 10-day advance decline ratio, basically a breadth thrust. There was a lot of talk about breadth thrusts over the last couple of years, and the idea here was that, well, only a few stocks were pushing to new all-time highs, and that left the rest of the market lagging behind. That caught up, so that narrative got destroyed, smashed into the ground once again. And so now we look at the breadth thrust. Basically, a lot of the stocks dropping and then rebounding quite quickly. This is a sign of basically a very volatile market, and typically you see very volatile markets towards the end of their cycle. So although I'm in the camp of a major bull market here, we're in the winner's curse phase, as I'll show you in just a sec. Basically, this is some of the symptoms of a market coming to an end. Lots of extreme volatility. Now, when I say end, we're looking at a major cycle here. This can last 14, 15 years to the way to the upside, and then several years to the downside. Not like that 10 months we saw in 2022. So there's a lot of nuances here, a lot of things we need to continue to recap day by day. But essentially, just looking at this particular data, stocks dropping and then rebounding quite quickly in a short period of time, thrusting to a new 2-year high. When this occurs over the last 17 signals going back 70 years, 1954, as I said, on the S&P 500 financials. Looking out from this signal, 6 months later, there's an 88% chance that the stock market would be higher. So basically 9 out of 10 times the stock market will be higher. And 12 months later, 8 out of 10 times the stock market will be higher. Now, it's not a great signal for the short term. You can see here it's basically flip a coin if you're just looking out 1 week. And again, if you're looking 2 months, 3 months, not much better than a coin flip. So you don't really want to use these types of signals in the short term, because what can happen is the market drops, like we saw into that fearful economic recession call of the Japanese yen carry trade on the 5th of August. Markets dropped. Now they've rebounded. What can happen in the short term is another correction into another low. Maybe it's a higher low, maybe it's a slightly lower low, or maybe we've just printed the low and we're going to shoot to new all-time highs. Honestly, I don't know, and we're not trying to forecast what happens in the very short term. I like to have something smoothed over, basically leave a lot of the day-to-day stuff out of the equation, basically the fearful news headlines one day and then the positive stuff the next day. You see it in headlines across everything, even on YouTube. And yes, everyone is guilty of it, but that's how the markets work. And that's how people miss out on the real moves themselves, where when you look 6 to 12 months out, well, the probabilities are really on your side. So that's the first one here. Financials after a 10-day advance decline ratio, breadth thrust, 2-year high. So the next one here, put call ratio, very similar here, where you're seeing the imbalances between the two ratios. So the equity put call ratio indicator fits this description, looking at how it's helpful in identifying buyable pullbacks in an ongoing uptrend. So this signal has shown up at pretty good times across the course of the S&P 500 going back to 1997. Looking forward 6 to 12 months. The positive rate here, 93%, 92%. So 9 out of 10 times you're likely going to see the stock market up higher. And yes, 1 out of those 10 times it's going to be wrong. You're going to see the stock market lower. The problem with this is most, as we know from watching news, looking at headlines, and again, reading comments as well. Absolutely okay. It seems quite logical that the market should collapse eventually, but essentially, you really only see it 1 out of 10 times, and even less if you're following a major bull market cycle, as we talk about with the real estate cycle. So if you're just waiting for that 1 out of 10 years, you are probably going to lose a lot of money. That's not what we want to do here. We don't want to lose a lot of money because markets generally go up over the longer term. And yes, everyone waits for these big downturn moments, but once you start to see the market breakdown, that's pretty much where your signs are. And we do talk about invalidation levels here as well. So if we did see the market come down, well, we're probably going to see it come down even further once it breaks past key invalidation levels. So looking at this data here, the equity put call ratio spikes. We've seen this. The data shows up going back to 1998. Some pretty good percentages here, 9 out of 10 times. Likely going to see the stock markets even higher, which is good news for Bitcoin and cryptos, and everything continuing to pile on in the into risk assets, more money flowing out into the space. More economic data here. Just looking at European inflation expectations dropped to lowest level since 2022. Now, I think this one's an interesting one to talk about because we've seen a lot of fearful news out of Europe, and some people love to marry the two together about Europe and what's going on over there, and then marry that across to the US. But the US is the leader. You guys watching from the US, the most money is there. It's the biggest powerhouse in the world. Still, no matter what people say about China and the rest of it, it's still the biggest powerhouse. But nonetheless, overall, looking at the inflation swap rates here, 5 years, looking at the US, they're dropping off down to lowest level since 2022. Europe and the UK down to lowest levels again since 2022. So in terms of inflation, things are starting to come down, and some, yes, have looked at the interest rates. Maybe those interest rates do get cut, but we're also seeing higher asset prices. So that's going to be the tricky one for the Fed to work out. On top of that, there were some suggestions, comments from the last video looking at the unemployment rate. What I find fascinating, every single video, every single week, there is something new that the masses are only thinking about, and they forget about everything else that we've covered for the last several years here on the channel. And yes, the unemployment rate is ticking up. And basically, every time, going back to the 1940s, every time it starts to tick up, recession hits. That's what this gray marking is in the background. Unemployment ticks up, recession. Unemployment ticks up, recession. Unemployment ticks up, recession. So on and so forth. Basically, recession each of those times. Something else that hasn't happened before was the yield curve inversion. So basically the yield curve dropping down, and it's basically been inverted for the longest time in history. And now what people are waiting for is the uninversion, when the yield curve comes back above that level. Now I know I've just switched from unemployment to yield curve, but the point I'm making here is the news headlines and the narratives and the reading of that particular data by the media outlets, and maybe by some people that you watch online, I don't know, is that they wait for this and say, this is going to be a recession when it drops underneath this reading. Then it doesn't happen, which we haven't seen a recession. What about if we are in a recession and no one knows? Maybe we are. Who the hell flipping cares if you're just following the damn price chart? The price chart is up and has been up for many, many years. There's been a 10-month correction, been a great time to accumulate, the price chart is up. So what I'm saying here is, maybe you see that happen and they're just saying it's going to be a recession. Then they're waiting for the uninversion. Then they say, all right, that's going to be when the recession is. But then there's also a time delay once it uninverts to when the recession happens. So you got a moving goalpost over and over again for many years, which makes people sit on the sidelines, not make any money, and then get into the markets too late. So the round story there about the unemployment rate is, well, one, maybe we do see that recession get called. But my point is, trade the price chart, not the call of recession. The second point here is, maybe we see this tick up and there is no recession and it starts to tick back down again. Maybe that's a possibility as well. So we've seen the longest inversion, yield curve inversion in history. Now we're waiting for the uninversion, still no recession. Maybe something crazy happens like this on the unemployment rate figures. We just don't know. So the point I continue to come back to is just follow the price chart. If you're looking to get into the market, look for good buying opportunities. We've talked about data points here that favor when it's helpful, buyable pullbacks in an ongoing uptrend, and not focusing on the unemployment on its own, because it's not a great indicator just on its own. Other things have to come together as well. M2, the money stock here, the money supply. And that has also been noted that we're starting to see this tick up once again, more money starting to flow back into the system. And so the main idea here is that people see, well, when there's more money in the system, you start to see a lot of asset prices also go up. Now, of course, that's also been true, and you typically see the money supply continue up even through some of the recessions to get us out of the recessions. So it could all be true. Logically speaking, it could all be true. We could be seeing more money supply come in. We could be in some sort of hidden secret recession. We could be seeing unemployment go up, which triggers off something else to do with the recession. Again, there's a lot of ifs and thens about this particular type of data. What am I going to do? I'm going to simplify it. And if you don't want to simplify it, completely up to you. I'm going to try and bring together all these economic pieces of data to try and figure it out, by all means. But I'm going to simplify it and just come back to the price chart. At the moment, price chart is up. We're at historical levels. We've just closed the second highest week in history. That was last week. Not saying that this is it. Not saying that this is it going to just run to a new all-time high. I do love the look of these sorts of corrections, but what I love the look of and what the market does sometimes are two different things. But I'm not trying to get too excited here until we see further consolidation above some of these swing bottoms, roughly around 5,500 points. And it could even come all the way back to 5,300 points. So if you saw some sort of correction over the coming weeks, September isn't always a great time for the S&P 500. And then you sort of lead around into October and start to climb its way out, leading into that election as well in November. So that's part of our seasonal patterns. So the price chart looks relatively all right here. 1.2% away from a new all-time high. Pretty crazy to think that it was just 2.5 weeks ago, basically 3 weeks ago, this low here was the end of the world. Recession, extreme calls for emergency interest rate meetings and cuts had to come out. A few more weeks away until we see anything to do with interest rates and the Fed. So let's just keep following the chart, see if we get any sort of follow through into new all-time highs or pullbacks to key support levels along this journey. And some of those, as I said, around the lows here, 55, 54 to the 50% level, and then back to the previous low areas, you got 52 and 53. So basically every 100 points on the way down to keep it nice round numbers, provided you don't see any of these moves break down from the major 50% and back underneath the old all-time highs on a closing basis, then you're still within a pretty reasonable area for further upside along this macro bull market. Okay, let's have a look at this macro bull market on the 18.6 year cycle, real estate and economic cycle. Bitcoin's a different thing. We're going to get to that. And also the stock markets run similarly, but they might continue on a little higher past this peak of 2025, 2026. So some peak around there, and then the correction from that point. So we are within the winner's curse phase now. Basically, a lot of asset prices going up. These are some of the unpopular opinions I had in December of 2022. I said back then, real estate is not going to crash in 2023, and I'll show you a chart in just a sec. Also said Bitcoin was bottoming then. Second half of 2022 and the first half of 2023 were buying opportunities. Yes, that's all come true. And S&P is bottoming, not crashing. And most cryptos were terrible DCA investments. Trading, on the other hand, holding for a few months, getting out some massive gains through late 2023, early 2024, pretty good. But DCAing, we're now seeing them come all the way back to those levels of 2023 for a lot of them. Not all of them, but a lot of them. So let's go back to this one here, real estate. Another historic close, major push to the upside here for the home builders ETF. This was an all-time high weekly close for the home builders ETF. So why is the home builders ETF important? Well, the investors the market essentially is still seeing further upside, further profits to be made with the home builders. Therefore, you would expect that, well, real estate prices are also going to continue up. There's been no alarm bells yet triggered. Things are still looking relatively good, especially with a new all-time high daily close. And yes, as I talked about earlier, the volatility starts to increase a lot and the moves to the upside get faster. You can just sort of swing that yourself, drawing on the chart. They start to run up quicker. They could pause out here and take some more time just to level out. That's a possibility. But essentially what you do see at the end of these cycles are pretty fast moves because everyone's starting to figure out that they were late and they're trying to get on board with more profit or try to get some profits that a lot of them missed out on. Because if you've been following the news, and even if you haven't followed this channel, you know from the news that there was a recession being called every single year after 2020. There was something bad going on. And if you weren't following a price chart, you would have thought the market prices were going down. But they have absolutely skyrocketed from that point. Look at the COVID crash low at 26, 25 to the current price at 100 and call it 20, right? It has done many, many multiples now since that point. And every year we were told there was going to be a recession. Eventually there will come a recession, but it's better just to continue to follow the chart. On that note, the guys that have been following the charts here with our members, making absolute crazy gains. And we've got a free UTA coming up this week. It's an Ultimate Trader Accelerator, a free live stream. Use the link in the video description and become an Ultimate Trader for free now. Just drop your email, create an account, and you'll have to use the links in the video description for Bybit, Bluffin, or CoinCatch to sign up to that. But of course, the membership here and the group is absolutely free once you come on board with that. So congrats to all the guys who are making significant gains. Pretty decent one there, 2100. Closed out their say trade at 1000% and other great returns here as well. So big ups to you guys. All right, so let's carry on with Bitcoin and crypto now, looking at some of those major charts here for BTC and some pretty big things on the monthly there. Fear and Greed Index, the market sentiment here, 55. Basically in the neutral zone. I'm going to call it neutral because yesterday was 54. That was neutral. Today's one tick higher at 55. But essentially, you can see we might have ground our way out of the extreme fear and then the fear, and we're starting to climb back into that neutral zone after, again, the major news that was supposed to collapse the markets, the Japanese yen carry trade that happened 3 weeks ago. In that period, the Bitcoin search volume has dropped off, continued to drop off. I like covering this one here because it just shows us where we sit in the cycle, provided we're on the same page that we think that the macro bull market is still in play. And sure, we've heard many people say it's not possible. Bitcoin's going to drop to 40 grand. That's okay. We all have different opinions here. You're listening to my opinion today. 20 is what the reading is here. And typically what I've noticed is, well, you go through these quiet times, the masses miss out. They're basically on the sidelines waiting for that next move to the upside, that next pump. And I think that pump is brewing. It has been brewing for some time. We've definitely seen that 5 months, as we've talked about on the channel from March. Our signal told us, well, this was just way too hot. It needed time to cool off. I've been looking at 4 to 6 months under that old all-time high. We're now into our 5th month, coming to an end in 6 days' time, and possibly even a green month after that collapse there. And at the beginning of the month, I looked at the possibility of August being green because, well, in more times than not, August follows July. We get that green in there. So the Google search volume is dropping off. That's what you do like to see before these big moves. And we've got some big moves for Bitcoin possibly coming up. I can't say for sure because obviously I don't control the future. The next thing that is showing that sign, the daily exchange volume on the 7-day moving average. Now, if you follow Michael's channel, I've got a link to that in the video description here. I'll fix that one up for you guys. And yes, Michael is my brother. How many people do you see that have the surname Pizzino? Go and check out his channel as well. He's been following the exchange volume because you want to see more money coming into the space to kickstart these big moves. And that's when you typically see a lot more of that money come through at the breakings of significant key levels, like the all-time high, getting back to, once this market gets back to like $74,000. Looking at the volume back at that accumulation zone of August, September, October before the breakout, it was barely anything. It was pretty much dead back then. 10 billion, 9 billion, $12 billion of 7-day moving average trading volume. Now we're back into this zone of sort of 30 to 40 billion dollars after that one quick spike on the flush out to the downside, and back in that 30 to 40 billion dollars. We have a look overall. The beauty about the space at the moment, and at least throughout its entire history, is that it's printing higher lows. So although things cool off, it gets boring, people leave the space, the exchange volume continues to put in higher lows at the quietest times in the market. So you've got the low itself when FTX collapsed, and then you've got that move after Bitcoin went from 19K to 32K and then basically died off again in the middle of last year. And then that took some big volume. And now it seems like the exchange volume is putting in another higher low at roughly 20 to 30 billion as that low. And then it continues up. So the positives here are it's still quiet. Yes, the price is trickling up, but you're starting to see some good signs that more people are sticking around and waiting for this next pump. And more people are trading the markets. The good news here is that you're seeing high lows, more money staying in the system, more money trading in the system, and ideally more money continuing to come in and then pump to those new fresh prices. At least that's what we've seen on each of the previous occasions. Higher lows, breakout, higher lows, breakout, higher lows, breakout. So let's have a look at how that continues on with the Wall Street cheat sheet, just looking at the psychology of a market. It seems like we've gone through that disbelief that this rally is like all others and it will fail. And we're on this climb up yet again to try and test those levels at around $70,000. So I still think we've got this stage of the market to get through on the longer term scale, your optimism, belief, euphoria, and thrill. And then you get into that complacency stage. So a lot of the new money will continue to buy up those lows as it continues to drop because they've gotten in late, and we can see that from the exchange volume. They're not here. The search volume, they're not here. And the volume on the price chart also shows that the action has been quite lackluster. So in terms of this cycle here, what has been very similar, if not almost identical to each of the previous cycles before that big breakout, this major historic move, are the accumulation zones. So I want to have a look at these now on the longer term scale here, going back to the first cycle. And as Michael calls it, the Genesis cycle, basically that first cycle where Bitcoin went from a few bucks up to $1,200. Okay, so the main thing I'm looking at here are the accumulation zones after significant breaks. You got this big move to the upside, $2 to $8, lots of percentage in terms of percentage of the big move. 5 months of consolidation. Next breakout, 4 months of consolidation. Major breakout, 5 months of another consolidation. And it's happened once, twice, 3 times in its way up to that final peak, which we know lasted roughly about 37 months. Next 14-month decline into this next cycle peak in 2017, 8 months, 5 months, 5 months, and then you really don't get another look in. You got a month here, a month there, within a month there, so like 2 weeks that is, and these get really extreme. As I said earlier in the video, as you lead into these final peaks, and this happens for all markets, things get far more volatile, and that definitely shows up in each of the previous cycles here for BTC. You get some slow grinding times, the times you don't want to miss out on, but make you feel like, is it really on? Is it really not? And then it basically takes off from that point. And you think, why didn't I just listen to my intuition? Or why don't I just follow my plan? More importantly, why don't you follow your plan? Come forward to the next cycle, the last cycle we just had, 2019 accumulation, roughly 4.5 months. This one here, living through it, did feel like another accumulation. And I mean, taking out COVID here, it definitely jumps straight back into that price range. So through that time, you saw the volume drop off and the green bars really start to tick up. COVID happened, flushed out the last of all of the sellers, and then there was basically no look back from that point. So for my own sake, my own analysis, I look at this as another accumulation zone. Maybe 2, 3, 4 months through this period here, based on what I can see on the volume and how the market was responding there. COVID flushed it out. and then came back into the zone, giving us our third accumulation. Then basically it took off and there was just no chance really to get back in, or if you were hoping for bigger declines, they didn't come until the 65K peak. So you had that opportunity there before the end, and basically the interest was dead. The interest was basically dead compared to this interest here on that pump up. So that's an important one to watch with the volume. Now, this is where I see it. We find ourselves at an 8-month accumulation, a 6-month accumulation, and roughly around a 5 to 6 month accumulation so far. We haven't broken out of this yet, so that's the important part here. There is still no confirmation of the breakout, but you can either A, wait for the confirmation of the breakout, or try to anticipate that this is going to be that accumulation or reaccumulation before the breakout. Because remember, when you look back and you're living through these periods at the time, you don't know that, well, COVID's going to happen and dump you out and then not really give you another chance at those lower prices and take off. So while you're living through it here, you have to assume that you've got one accumulation and the next accumulation because the market was heading up. And then you get your third opportunity and basically game over from that point. You really didn't have any more opportunities at those lower prices. Same deal at the previous cycle, market takes off from there. And then again, you had these opportunities and you don't often get that pullback to that previous price range. You're basically left hoping and waiting, like what we're seeing now, people waiting for prices under 40 grand or even under 50 grand again, and then they potentially don't get that opportunity. You can see there's a pretty decent range here, $6 to these lows here at around $9. So in terms of percentage, quite a lot. Market takes off without them because they're all getting greedy, hoping for $6, $7, $8, and it takes off. So fast forwarding to today's action, you had that opportunity underneath 50. You had plenty of opportunities underneath 60. I don't know if we go underneath 60 again. If we do, how long is that for? Maybe a matter of minutes like we've seen in the past. And then we just look for further signs of this bull market continuing on. The volume has been dropping off. We've seen relatively good volume on the up months. So you've got the green months here trying to push higher. And now we're seeing this month potentially in the next 6 days close at very high levels yet again. On analyzing the last 3 cycles, this looks quite similar to the last few where we have these 3 periods of reaccumulation. Now, as I said, there hasn't been any confirmation of the breakout yet, but it's trading. You can't always wait for all of the guaranteed trades to happen. You can have options to get in a little earlier, but with key or clear invalidation levels in case it doesn't work out. And that's the game that we play here with trading and investing. You're working on your risk and reward. Take the risk now, get bigger rewards later, or wait for that confirmation and get lower rewards later. Entirely up to you. It's a very individual game, this trading and investing. But for your own sake, I hope you're able to take this away, implement it into your portfolio the way you see fit. And in future videos, I'm going to go into some stronger altcoins on the channel. Like, subscribe, and don't forget our free Ultimate Trader Accelerator is coming up this Thursday. Get on board now. Link is in the top of the video description. Register now, and I'll see you guys over there for our live trading session. All right, guys, thanks again. I'll see you at the next video. Until then, take care and peace out.